Folks, thank you for tuning in to our webinar regarding our private credit fund. This is an exact way that we are going to unlock the path to wealth and freedom using this investment vehicle. Again, this is for accredited investors only, so let's dive right in. All right, before we get into the details of the private credit fund, we have to go through our legal disclaimer, right? It's very important that you, as an investor, read through this carefully and know what you are investing in. So, the information presented herein is prepared for informational purposes only and is not an offer to buy, sell, or solicit a security or fund in any financial instrument may not be considered investment advice. The following information here presented propose a creation of a special purpose vehicle or issuer, which is a security. Next, the views and opinions expressed here are solely those of our sponsor team, Valoris Capital Partners, and our affiliated partners, and are subject to change based on market conditions. And although the information presented here and is obtained based on the sponsors, our best beliefs and reliable information, that can change in an instant, right? So just so you're aware, investments discussed may fluctuate in price or value, and investors may not get back as much as they invested. They may get back less than they invested. Forward-looking information here is contained in material and subject inherent limitations. Information in here is purely historical in nature and may include other things, expected structural features and anticipated ratings, proposed and target compensation, and proposed diversification and sector investment, and other fun things like that. So continue to read this if you really want to understand all about this in detail. Now, prospective investors should understand that the assumptions and evaluations, whether they were appropriate for purposes, materials in here may be historical data, and it may not be. Historical trends are not reliable indicators of future behavior, right? So make sure you're paying attention to what the risks are associated with these certain investments. Past performance is not indicative to future results. You've heard that over and over again, right? So make sure that you understand that given the inherent volatility of securities market, it is to be assumed that all investors with experienced returns comparable to those shown here, market and economic conditions may change in the future, producing material different changes than we've here. All investments have inherent risk. Please reach out to your financial or tax or law professionals if you have any questions. So as we move on, what are you about to learn here today? So we are offering a private credit fund that delivers up to 14% preferred returns, nearly double what the S&P 500 is doing right now, without the daily market swings, right? So if you're looking for monthly cash flow, you're looking for distributions that come in on a consistent basis. You want to put your money into a vehicle that provides a way to outperform any high yield savings account, any money market account. This is your opportunity. We're going to give you behind the look scenes at our streamlined process. We're going to cover acquisitions, renovations, asset management, and we're also going to cover why you should look for truly passive income without the hassle. Now, another thing we're going to go in a little in depth and explore today is the properties that we have in the fund, our strategies, and why we believe this will outperform any market out there. All right. So as we continue to go, who is your fund manager? Who are your team? Well, it's Valoris Capital Partners, friends. We are a multifamily investment firm. We have over 150 million of assets under management. We have over 1,800 doors under management and development as well. We provide our investors with a hassle-free way to invest in alternative assets that can provide great returns, outbeating any markets out there. Again, this is a very strong risk-adjusted return fund, right? So please stick with us so we can have an opportunity to really show you guys why we love private credit and why now is the time to invest. All right, so before we get there, I want to give you an example or give you an opportunity of who is our team, all right? Well, who do we consist of, right? So Valoris Capital Partners consist of Claudio Sanchez, I'm Jeff Ervick, your host, Ritesh Patel, Jim Bone, and Paul Landman. With us today, we also have a special guest, one of our very, very key partners, which I'm excited as these two key partners are both with us on this fund. But we'll pass the mic over to Aisha Khalid so she can do a quick little introduction of herself as well.
Yeah, thanks, Jeff. I'm super excited with this opportunity. My name is Aisha Khalid, and I am managing partner at Apex Multifamily Capital. And I will say that having worked with Valoris on several deals at this time, I think diversification, diversification, diversification. That's why I'm excited about this private credit fund, a very different opportunity than the stock market or multifamily deals. And Jeff will show you how.
Excellent. And another partner on our fund is right there in the middle, Janine Witten. She is a longtime friend and partner of Valoris Capital Partners. We've also done multiple deals with Janine and her team, and we're excited to have her. She couldn't make it today, but we're excited to have her on the team as well. And then also our extended team, right? Our back office team. We have Ernie Perez and Odalis Beltre, who run our asset management, along with Paul Lamon. And then we have our financial background with Jasmine, and then our marketing director, Joelle, and our web specialist, David, and Jermaine, who does all our graphic design. So that's our full team for Valoris Capital Partners. We're excited to have it. Now, who are we? What do we do? We have 20 years of experience. We've acquired over 1,800 units in management and development. We've produced up to 14% annual returns for this fund, which is exciting. We've deployed over 40 million of equity, and we have 150 million of assets under management. So, guys, we are experienced operators in the business, and we're very excited to share our new offering, our private credit fund. All right, so let's get into it. What is private credit, and why are we excited about it? Right, so our fund, right, provides a private credit loan. So what is private credit, right? Before I go into that statement right there, private credit is a private loan to a business that needs additional capital, right? And there are specific reasons why they might need additional capital. And we vet that reason and make sure that we're fully anticipated of what the outcome is going to be for that. So it's an alternative credit funding to real estate sponsors, and it's backed by a strong position in the capital stack, all right, that provides consistent monthly cash flow. So if you look at this diagram here on the right, you've got a couple different pictures, and actually I'm going to minimize this real quick so I can show that. All right, so there you go. So your traditional capital stack, right? It looks like this little building right here on the side. On the way bottom in the dark blue, right, is your senior debt, right, or your loan from a institutional lender like Freddie Mac or Fannie Mae. That is a minimal risk, right, because it's the first one to get paid. It's a first lien position, but it has minimal reward, right? So they're very low interest rates. Well, obviously, right now we're in the sevens and eights, but if you look at traditionally, they're anywhere from a 3.75 up to a 6% interest rate, 6.5% interest rate for these. So, but they're minimal risk, and they're long term loans. Then at the way top, I'm going to skip the bottom. At way top, you've got your maximum risk, maximum reward, right? So that is your LP equity, your limited partner equity. Now, what that does is it provides a sometimes up to 20-25% annual return. Might not have cash flow for the first couple of years, and everything depends on that property executing in the business plan in order for this investor to get paid. Now they are the last to get paid in this capital stack. Now, right in the middle, right in that nice light green teal, I call it seafoam green, whatever you want to call it, is
Nice.
our Valoris Capital Partners private credit fund. Right, it's the ideal balance between minimizing or de-risking your investment and earning a really good return on your investment. Right, and why are we able to do that? Is because we're providing up to 14% average returns, right? And we're doing a annual cash on cash return of 6% distributed monthly. All right. So how does that work? Right. So we are coming into the business, right, with providing a loan that's written into contractually obligated into the property to provide a loan. So we get paid after the senior debt, right, in line with it. We're subordinate to that loan, but we get paid before any equity, right? So we are a consistent cash flow monthly, and then that also accrues another interest rate, which is again contractually obligated into that fund and gets paid before any equity gets paid.
So I just want to highlight, I
Yeah.
think, Jeff, everything you said, for those of you out there where real estate is new and the terms are new and the lending is new, what Jeff's really showing you with that building analogy, which I love, is that most of the time, if you're jumping from putting your money let's call it a money market or a high yield savings, right? Again, minimal risk, minimal reward. I think of it that way. And then I think, gosh, I'm going to go out there and I'm going to invest in a land development deal, which we've offered folks, but we're telling you, you're going to get the reward 5, 7, 10 years out. This is something in the middle. This is telling you your percentage is going to be higher than holding your money in the bank or under your mattress in these times. And then that being said, we're not only giving you monthly cash back, which Jeff will outline, but we're also giving you a very decent percentage. And I want you guys to take the word consistent. It's a consistent percentage because it's based on some properties in the fund that will show you that are already cash flowing. The buildings are built, the buildings are full, they're already cash flowing, and we'll come back to that. Okay, so how can you get involved in this deal? So here we have our investor returns. And to give you an example of the classes of investment that this great private credit fund will offer you, you start with class A1. You can see that on the left, 500K minimum investment. And what that's going to get you is that 14% return that we mentioned. You're going to start with a 6% current pay. So that's annualized and divided and paid monthly. So you're getting those monthly distributions, but at the same time, you're accruing that 8% annual return paid at a capital event. On the other hand, if you choose to invest 250K minimum as your investment, you're then dividing it. So you're getting a 12% preferred return. And again, you're getting that 6% annual divided monthly as a distribution, and then also 6% annual that's accruing along the way, again, paid as a capital event. We'll show you this diagrammatically, but we just want to get you excited at this point about investing. And finally, if you're doing class A3, so that's 100K minimum investment, you're getting a 10% return. And this is a consistent, stable 10% return where you're getting that 5% monthly payment distributions every single month. And then you're also getting 5% that's accruing as an annual return, and that's 10% per year. So let's go to the next slide so Jeff can show you how this will break out.
I appreciate it, Aisha. That was excellent. Yeah. So if you guys look at this diagram we have here, our investor returns for A1 on the first class, right? So minimum investment, like I mentioned, is 500,000. It's a 6% current return, right, and 8% accrued. So year one distributions will look like $30,000 divided by 12 months. And then we accrue an additional 40,000 each year, right? So you see that goes in the same for year two and year three. So after year three or after our exit, our capital exit, right, whether it's a sale or refinance, like I mentioned earlier, the fund is a 3 to 5 year fund, right? So after that third year is why we showed you this as a simple way to look at it, right? But you will return your capital, your initial capital 500 gets returned, plus your overall investment returns are 210,000. That's a 30,000 times three and a 40,000 times three, or 6 and 8%, respectively. So that gives you a 42% return on your money. Pretty amazing compared to what the current market does right now at an average return of not even 7%. So again, if you see A2, it goes down for 250,000, 6 and 6, and then A3 is 100,000, which is 5 and 5. So total return on investment for those are 36 and 30% respectively.
And I'll say even that A3 investment's getting you a 30% return, Jeff, which again is consistent and stable over time. And I just want to reemphasize that point.
Yeah, it's beautiful. I mean, it's a great way to earn, again, consistent passive income, which is why we created the fund in the first place. We noticed that a lot of our investors are invested in real estate, but they're not getting those passive returns because they're delayed for value add rehabs or waiting on an exit to be able to get any cash flow at all. So this is a great way to be able to get cash flow if you're already invested into a property like that, like a value add property. And even Aisha, you and I mentioned this earlier. We were talking about it too. Is this fund does not offer a depreciation because again, it's a private loan, a private credit.
Right. Right.
But if you're invested in one of our other deals, for example, you're going to be able to get a depreciation or get a K1 with a passive loss. And as a W-2 employee, unless you're a real estate professional, you're not able to take care or take that loss and apply it to your active income. But what you can do is you can apply it to your passive income. So if you're earning 6% here and you want to pay taxes on that, you put some other money into a depreciable asset and you get that K1 annually and you can write those two off. They kind of negate each other. But again, talk to your
And I
CPA and your tax professional for that advice, though.
I was just going to say that we're obviously not tax professionals, and we said that in the disclaimer, but investors always ask, your deal mentions, the other deals have mentioned depreciation and passive losses. How will I be able to take that? And I think you explained that brilliantly. Most of our healthcare investors are W-2 employees. And second, people worry about capital gains, right? So if they're getting gains on this deal, but they're able to offset that with losses from other deals, that's a perfect blend because they both are path of income. I think that's an excellent point.
Yeah, beautiful. Yeah, I love it. I mean, that's what I do too, right? So, all right. So now let's talk about one of the current deals in our fund. This is the first deal that our fund will be investing in. It's called the August at Friendswood. It's a 249 unit multifamily Class A 2020 build in Friendswood, Texas, or just outside of Houston, Texas. It's in an amazing location, right? And so we talked earlier about, hey, what would we invest in, right? We were going to be investing in the fund. We'll be lending to Class A properties that need some type of capital infusion, right? And they need that capital infusion because they've purchased the property back in 2020 or 2021 when the interest rates were low and they crept up very fast on them. So there now interest rates are pushing 7, 8, 9%. And we look for those kind of opportunities that need that capital infusion to go through a refinance. Now, it's very important that we vet and underwrite this property very specifically that it can go through refinance. Not every property or not every deal in this kind of situation can go because of the economics don't work for them to refinance. Maybe there's not enough NOI, there's not enough occupancy, there's not enough reserves, whatever it might be. So, but this property, we went through that and we vetted it very well. All right. So it's now refinancing out of this higher interest rate into a low fixed 3.75% rate, right? And that is an amazing rate to be able to get right now in this time market. And that's what our fund is going to provide is a private credit to be able to get this property refinanced and move into that new lower debt. The next thing we look at is making sure it's a highly occupied um, uh, property, right? So we want to make sure it's be able to pay the current debt, right, that it's currently in, and that's what this property does. It currently is able to pay all the debt and all the expenses of the current status. Now, once we lower that interest rate, it's going to be able to have a lot more free cash flow, but that's where our private credit fund comes in because we're written into the contract, into the operating agreement of the property to be able to get simultaneous distributions right in line with our senior debt. And next is going to be new management. So it's going to be enhanced management to be able to enhance operational and tenant efficiencies and tenant experiences. Again, there's a couple of things I want to make sure we are talking about here when and how properties like this are valued, right? And one thing actually I didn't mention, number one, there is the tax abatement. All right,
I was
so
going to ask you, what is that
yeah,
100% tax abatement written at the top?
yeah, so 100% tax abatement. So what that does is when we have an area where we can keep the rents at a little bit lower than market, right? But offer that to a resident who might not make the AMI or the average median income of that area. Maybe they're closer to about 80%. So let's say the AMI is 100,000 just for round numbers, and they have an $80,000 salary. All right, that's what they have for their income. We offer them a little bit lower rent, right? And we also then are able to negate all of our taxes on that actual unit, right? So then we don't pay the massive bill for taxes because we're lowering our tax bill throughout the property. So this property or our deals have to have two things happen, have to be able to refinance and have to be able to put a tax abatement in place to be able to get and pay for the current debt on the property. So that is a beauty about it, what we're looking for. So that's why this property we think, or this deal, this private credit fund is amazing. And again, this is just the first deal in our fund. We've got two more like this stacked up right behind it. So we're going to have a lot of good opportunities for our fund as we continue to move through the year.
If I'm an investor, Jeff, just to ask questions on that taxes, is it just for 2025?
No, it's for the life of the tax abatement, which can also move to the next owner when we sell the property as well too.
Perfect.
Yeah. So again, why do we like these opportunities? And why we like to invest in private credit is because it delivers consistent monthly cash flow, and it's not an equity investment, right? So you're not investing in an equity position or a limited partnership position in a deal. You're investing in a credit opportunity or a loan, a lending opportunity. It's positioned uh, better in a capital stack, so higher in a capital stack where it's going to then have less risk and it has good returns. It's not completely on the other end of the capital stack where most LPs or most equity investments are, where you've got the highest risk and the highest return potential. Right, we're right in the middle, like we talked about earlier today. And then obviously this outperforms any high yield savings account you can find on the market, even during COVID, right? When the
Right.
interest rates were
Right.
yeah, when the interest rates were huge and they were paying 5% plus on those high yield savings accounts, they can't do that anymore. They're now closer to 3.75, maybe three, maybe four you can find if you're lucky, or a CD maybe pays a 25 basis points higher. This is paying 6% on an annual basis distributed monthly. And obviously with inflation, anywhere from 2.9 to 3.3%, it's going to be able to secure and outpace that inflation cost. So your money will consistently be making money for you. And then if you, like talked about earlier, if you're able to take advantage of any depreciation from some previous opportunities, you can write it off against this, and that really is pure cash flow for you. So, the criteria, right? Let's go back through it again. I know this was a lot of information, but I want to go back through it one more time. We are going to look for seasoned deal operators. And what that means is that the deal must be cash flowing and paying its current debt, right? What they're looking for is opportunities to be able to restructure their current debt, right, into a better interest rate and improve expenses or decrease expenses by adding in a tax abatement. Because if you think about it, the three most expensive things on a rental property are what? There are your debt, your taxes, and your insurance. So we're taking care of two of the three right away, which greatly increases our net operating income. The minute we close this deal, the value of this property is just going to skyrocket. We also look for high growth areas, so areas that provide excellent job and have great job markets, have great growth in that market as well. This location in Houston is an excellent idea for that. And also a strategic business plan. So, what is the business plan, and have a clear path moving forward on that business plan? That is, what we talked about earlier as well. It's very important for us to make sure that there's not just a deal that is needing to cover interest debt because they're not able to meet their debt service. So we don't want that deal. We want the deals that can meet the debt service currently. And if we improve it by reducing taxes and reducing the interest rate, we can have a win-win for everybody. So, Aisha, do you want to talk about our vetting process of the sponsors, or?
Yeah, absolutely. So, you started to mention it, and there's a few things we're going to talk about. So, the first one is we have established relationships, Valoris, even longer than Apex Multifamily, with brokers, sponsors, and operators. But second, more importantly, what's written here is full due diligence on the asset. And I want to highlight that our combined approach is to be as conservative as possible. So the returns, obviously, we said at the beginning, nothing is guaranteed, but know this, we're trying to give you the most conservative estimates on what is going to happen, both on the percentage return, but more importantly, on the time frame that the asset is held. So we're doing all of that diligence. And I will say, Jeff, I guess let me ask, aren't there so many deals that we've said no to?
There's a lot. Yeah, we've said a lot, no to a lot of deals. And so making sure we find the right deal, the right sponsor, and the right partnership is important for us. And one thing to mention too, physically, we will physically go down to each location and view and tour and talk to the owners, talk to the current GP team, and that's what we did just about a month ago. We went down and toured this property and got a really good idea, and it is a beautiful place. Like you can see a picture right there. This is one of the deals in our fund. It looks like this. Imagine living in that place, right? I mean, it's gorgeous. So it's an amazing asset.
And I will say that, the information on the right is already shown with the fact that any successful team that's doing a good job, when the new management's coming in, they're coming into an asset that is already high occupancy, good tenants, paying rent, caught up with mortgages, and no outstanding sort of debts or liens on the property. And the reason that's important, and Jeff and I are highlighting this is very different than the value add deals that we may have shown investors in the past, where we're trying to really revamp the property. So this property is already revamped. You can see it in the photo, for example, and we're just taking it forward. Let's talk about markets, Jeff. Yeah, so market focus, as we talk about in real estate, there are certainly areas of the country, and I know Valoris Capital has focused on the states outlined here, but at the end of the day, before the asset or building is identified, states like Florida and Texas and Arkansas and Minnesota, the Carolinas are states that, we've done investments in. They're also states, for you to know, it's written on the left, people are moving to these places fundamentally. There are companies moving to these places, which is allowing for job growth, which is also allowing for people needing a place for a good apartment to rent. So let's talk about that. From the ages of 25 to 45, there's a huge movement of workers in this country. And we're looking at the markets baseline that are already having people moving in, and the demand for a good rental place is outpacing the supply. And then on top of that, whenever a company moves in or the tech sector moves in, you've got great schools. And finally, the cities and states are interested. So I know, Jeff, you've seen like Florida and Texas, for example, taxation laws, tax abatement opportunities, low interest rate loans being available from lenders because they want to encourage development. So we're not just willy-nilly identifying a building. The basis you can see on the map are the states that we're focused in.
Yeah, I mean, each location has to be a pro-business environment, right? And has to be landlord friendly with regulations, right? And that's important for us. Like you mentioned, not every state is like that, right? So we're going to look
Right.
at opportunities in states that we know that we have operated in. We've got local assets in those areas, and we've got a great team in place, and that's very, very important for sure.
And then the other thing we want to talk about, and at this point, everything we're saying should be reminding you of earlier points in the webinar. So the risk mitigation, risk protection is already built in. So there's a few things that are happening under the due diligence and underwriting property process. And that is, not only are we looking at the financials, but we're also looking to make sure. So we talk about these bad boy carve outs to protect investors. If there have been operators or lenders, anyone in the past that has had foreclosures or had issues with their properties, those are not the sponsors that we want to be working with, right? We want to do all of that process to protect you. And second, we really want to see that they're executing on the business plan and that they've been able to do that and get all of the same situation, looking at the rent rolls, going to the property, poking around, looking at the units, making sure everything looks right. On the right-hand side, Jeff alluded to this earlier. There has to be a clear exit strategy in the business plan. And when you look at real estate as an investor, people will tell you that there's flips within a year or two. They'll tell you there's deals that are in that 2 to 5 year range. And then they'll say, hey, listen, we'll triple your return in, 7 to 10 years. For this private credit fund, we want you to think about the fact that it is short term enough that between 2 to 4 years, we're having properties within the fund that are being exited or refinanced to be able to give you those increased returns. So we're not telling you to wait 7 to 8 years to get your money back. And then finally, I already mentioned it, but the underwriting's conservative, right? And the assumptions are pressure tested amongst all the teams to ensure that these properties are stable, which is then validated with the on-site visits. And that's important, Jeff. Not everyone sees a building that they're investing in. Not everyone does that. And I think we always do that.
Yeah, no, it is true. In fact, actually, Claudio went down and took a bunch of drone footage of the video, checking out the roofs, checking out the pool, the entire landscape. Yeah, so he toured all the video, all the properties, and future ones that we're looking at as far as bringing under the fund as well too. So multiple ways to do that. But yes, conservatively is amazing. And to talk about that bad boy carve out, right? So when somebody goes through a foreclosure in another property, they get listed on that bad boy list, right? And that's an actual term, by the way. For not being able to be refinanceable or have another loan with a institution. So we are making sure that those are not the sponsors we want to be with. All right. So what is our timeline? So we opened the fund in March. It's been open for about a couple weeks here. We already have investors pouring in, so it's very much moving very quickly. Our fund is a year-long fund, so we're going to continue to keep it open for a year. Again, first come, first serve. As soon as we raise that first 10 million, the fund will be closed, right? So please get your investments in early. If you're very interested, schedule a call with Aisha or myself to talk. And what we're going to do is we're going to execute the business plan over the next 4 years, right? And then
Mhm.
we'll look to sell the fund or liquidate the fund and close it down after year 5, right? So plan to be able to keep your money in again, it's a shorter term hold, 3 years, right? But your money will be tied up into fund where continually earning those returns. And then after an exit strategy, we'll have an opportunity to either divest out of your holdings or to reinvest it with us into a new deal.
So if I'm an investor, Jeff, I'm looking at timeline step 3 here. I think it's key for people to understand, am I getting returns this year? It says 2025 to 2029.
Oh yeah, you are. As soon as our first deal closes is when investors start getting returns, right? Which is going to happen in early May. So I would say yes,
This
100%. You put
summer.
your
Right.
money in, yep, and the next month after that, it's pro rata, right? Just like paying a mortgage, right? So if you put it in the middle of the month, you'll have a couple days of interest from that previous month, and then we pay in arrears as well too, just like a mortgage, same way. Cool. All right. So, how do we take action, right? If you're ready to take action, you can book a call with me and or check out our website. You can click the link there. Aisha, I do apologize. We will have your information in the show notes, right? But it
No
is,
worry.
if you want to list out your email real quick and your way to get a hold of you.
Yeah, absolutely. So it's Aisha, Ayesha, at apexmultifamilycapital.com. And we'll have all the links below the webinar. So reach out, reach early and often. And as Jeff said, we already have people that are interested. So this is going to fill up fast.
Excellent. Excellent. All right. So let's get into some frequently asked questions, right? So first and foremost, is Valoris charging me any fees on this fund? Because you see a lot of funds, and if you look deep into it and a lot of opportunities like that, there are fees that get charged and stacked up where your money is. We are not charging any fees to this fund, zero. The first 14% return goes back to our investors, right? And it's capped at 14, just so you're aware. So will we take any fees off that? Nada, zip, zilch,
I
nothing.
think that
All,
is so
yeah,
important, Jeff. And I know as folks are watching this, it was sort of a line on one of the slides, right? That the
yeah,
investors get paid first. Well, even when we do the multifamily deals, we're always telling, our teams are letting LPs know we want to make sure you're paid before we are. But I would say that it's very unusual for me to ever see a private credit fund where there's no fees being charged by management. So we really are trying to make your money work for you and put your money to work to show you that this model is a great model. And then we're heads down on the execution of that business plan that Jeff mentioned so that we're getting out in 2 to 4 years in each of the deals. And then that sequence just continues.
that's right. I love it. I mean, it's exactly it. So we want this to be as heavily investor friendly as possible, and that's what this exactly is. Now, how does the fund accrue the interest, right? Because we mentioned earlier, you're going to be paid a current interest of up to 6%, and you're going to have an accrued interest of up to 8% annually. So how do we do that? Well, we will contractually accrue interest annually with the properties in the fund, right? And that'll be based on the exit strategy or the cash flow currently in the deal as well too. Now these will be binding in an agreement with the property, right? So we are coming in, our fund will be coming in and documented and papered into the operating agreement for that property. That's how we are able to make sure our fund gets paid in succession from after senior debt. Our fund gets paid and returns all of our capital, and then the equity gets paid out to the investors afterwards, right? So that's a very important one there. Are there any returns over the preferred returns? Sorry, not for this offering. We're paying up to 14% on your investment annually. Do you offer depreciation for this investment? So no, since this is not a equity position in a multifamily property, this is a private credit investment. We will not offer any depreciation. But as you mentioned earlier, if you're getting depreciation from another deal you're in, and you can't take advantage of that for real estate professional status on your active income, that can offset your passive income. So, but again, talk to a tax professional. Next one, how safe is the investment? Well, I got to tell you that no investment is guaranteed, even the stock market. Look at what happened last, when the tariffs came in, right? It
Right.
dropped the stock market big time, right? So the beauty about it, though, is that our capital takes a lower spot in the capital stack, which gives you priority over the equity, right? So what does that mean? That means that we are paid first, right, before investor equity. So we're de-risking your investment into this private credit fund. And we'll do an average of a 65 to 75 loan to cost, right, for the last dollar in. So meaning that we will not go above a 75% LTV. In fact, we're also staying below a 70% to make sure we're ultra conservative on that. But it gives us the ability to go both sides. Now, when do you start receiving your cash flow, right? Monthly, right, is your cash flow, and it begins after closing the first deal in the fund, which, like I said, it's going to happen in
Dude.
early May. So please, if you're interested, now is the time to act and get your investment subscriptions in before it's closed out. And that's it. Aisha, anything else you want to add?
No, I think this is fantastic. I think if folks back up and think about private credit, I tell people there's the public markets. So for me, having been a W-2 worker for most of my life, right? I've had a 401k and that's been going in the public markets, i.e., the stock market, right? We are introducing you in the safest way that we can see possible into the private markets, which is how wealth is built very often in the country. So for those of you that, have your money in the bank, have your money in the market, and then worry about the interest rates going up and down, welcome to the private markets in even a safer way, I would say, just a less risky way than any of the multifamily deals or buying a real estate in your town and hoping you can sell it because the sale prices stay up. So I think in every way, people should understand that this is a world that is tough to get access in. The deal sizes are usually bigger, and I think we've priced it at a place where people can get in and we're not taking any fees.
That's excellent. And one thing I do want to add, which we didn't really talk about, is how to invest, right? How can you invest? You
Yes.
can invest with cash. Obviously, that's the first way you can easily invest in everything. I guess I'd say the most advantageous way, right? If you want to think about it, is through a self-directed IRA. Utilizing a self-directed IRA. And if you're not sure what that is, go look at one of our other webinars or do some research
We've all
on.
got them.
Yep, exactly. Do some research on there. Actually, you and I should probably do one here soon.
We should do one on that. Yes. And we
Yep.
should do one on, yep. I thought of a couple as you were talking on
Yeah,
terminology.
exactly. Yeah. So what a self-directed IRA is, and again, it's an IRA that you can determine where you want to invest your money in. So it's not just into the 10 mutual funds offered by that custodian. You can say, hey, I want to invest my $100,000 into a private credit fund. It comes back into your IRA tax-free. So beautiful way to do it. This cash flow play is an amazing way to build wealth in your self-directed IRA. So if you have one, go look at this opportunity. If you don't have one, go find a custodian, and I can give you a couple of recommendations if you.
And as a follow-up to what you said, Jeff, and I think we will do another, ways you can invest webinar. But when you get the money back, the returns that Jeff showed you in a self-directed IRA, those are not taxed. Everything coming out of a retirement account is going back into a retirement account, and it's just growing. It's like a little pot on the side growing until you're ready to pull it for retirement funds. So it's definitely a good option. And when you book the calls with us, we'll offer and tell you all of these, and then you see which one works best for you.
Excellent. Excellent. Well, I tell you what, I mean, I know people have been listening to us for about 35, 45 minutes. So I think now is a perfect time for us to say, you know what, sayonara. We appreciate the opportunity to hear us on this, and we hope you become an investor with Valor's Capital Partners and our private credit fund. So thank you so much, everybody. And if you have any questions, please reach out.
Thanks, Jeff.
All right. See you guys.